Welcome. My name's Geoff Driver, General Manager, Business Development and Investor Relations for Mirrabooka Investments. I have with me today Mark Freeman, the CEO and Managing Director of Mirrabooka Investments, and Kieran Kennedy, who's the Portfolio Manager responsible for Mirrabooka within the investment team. Mark, we just announced our results to the 31st of December 2021 for Mirrabooka. Pleasingly, there was an increase in income received from the portfolio, and we were able to maintain the interim dividend for the period at 3.5 cents per share, fully franked. Do you want to comment on the sort of major influences behind the increase in income for the period?
Sure, thank you, Geoff. Well, obviously the key feature was a bounce back in dividends from that COVID impact period over the last year and a half. So there were some companies that had cut their dividends during the period, or some had pared back their dividends. They're in the process of reinstating those, so that drove some better income from those particular stocks. There was also a stronger half in terms of realised gain. Obviously, the markets were very strong during the half, and we've been calling out that particularly the quality area of the market was very strong, and we were seeing some valuations that became quite stretched. However, during that period, due to some rebalancing we did as a result of high prices, we've had a good half in terms of realised gains, being around 27 million. I think it compares to the same period last year, where I think it was around 15 million. So it was a good period for Mirrabooka in that regard. However, going forward, and we'll touch on this with the outlook comments, the market did end the half very strongly with some very high valuations on some of the quality parts of the market.
Thanks, Mark. So, Kieran, Mirrabooka outperformed over the 6 and 12 month period. Do you want to sort of talk about some of the factors or key stocks within the portfolio that allowed that to happen or made that happen?
Thanks, Geoff. So first on a 6 month basis, as you mentioned, at the outperformance there, saw our portfolio up 11.1%, including the benefits of franking, versus 8.1% for the benchmark. So clearly a pretty pleasing result. The strongest contributors to that were some of our larger holdings performing really well in the market. Stocks like Macquarie Telecom, Mainfreight, ARB, Pinnacle Investments, Car Sales, James Hardie and Reece. And these stocks also were good contributors to the 12-month performance, where over that 12-month period to December, our portfolio, again including the benefits of franking, was up 26.1% versus 19.8% for the benchmark.
And Kieran, I guess Mark spoke about the sort of significant increase in realised gains through the period. What were the sort of major adjustments made to the portfolio through the 6 month period?
The first thing really is just to recalibrate our approach to markets. We're medium to long-term investors. So our assessments of the appropriate transactions to make is always on the view of what looks like the best opportunities on a 5-year view, take into account the share price, but also factoring in the long-term outlook. So we make sure we give good credit for the growth that our best companies can deliver. Throughout the period, we were starting to anticipate the conditions building around likely interest rate increases. We felt that rates were being kept low for longer than was probably appropriate. We're seeing that playing out recently. So that sort of backdrop saw us exit a position like Xero, which had been very successful for the portfolio, had run into the 50 leaders, so no longer in our universe, but valuations were getting stretched there. And then other really successful long-term holdings like Objective and ARB Corporation, we effectively just gave those a little bit of a haircut, just trimming some of those positions back again as those valuations got stretched. Other stocks we did exit in the period that are notable because we did hold them for a long period of time and did well out of them were stocks like Cube and Tassel Group. But in those cases, that was really around a more mature outlook and just not quite the conviction there. So then on the buying side, again, consistent with that view that there was building conditions for interest rates to increase, we felt we identified an opportunity in Computershare where we felt the market wasn't capturing the very significant leverage they have to positive interest rate movements. So we bought that early in the 6 month period, which has worked out to be very well timed. JB Hi-Fi is another stock we added to the portfolio. We've probably been a bit slow on this one. We've admired this company for many years, and we think that the market's currently very focused on what's likely to be a moderation in sales from a very high level at the moment. But we think just missing the fact that this is a category leader in a really good category in home electronics. So we think there's a good medium to long term outlook here with good income generation. And the other interesting stock that we did add to, it was a small position before this period, but is Peet Corporation, the residential land bank company. We've known this business for over 20 years. And again, we think there's some really good value in this share price at the moment, where the land bank's effectively not being reflected appropriately.
Thanks, Kieran. So, a question to both of you, Mark and Kieran. We've started off the new period of the calendar year in a quite volatile market. Mark, do you want to sort of comment on sort of a general market perspective, what you see is happening and potentially what the outlook is over the next few months or 6 months? And Kieran, you might comment specifically about how you're seeing it play out in terms of the Mirrabooka portfolio.
Yeah, well, thanks, Geoff. So it's obviously been a very volatile month of January, and really what's played out is that that view that I gave earlier, that valuations were looking pretty full at the end of December. Then with concerns around interest rate increases being a reality in the US and probably here in Australia, that's really been the catalyst then for an adjustment in the market in those valuations. So we've seen a pretty decent fall in markets. Some of the mid and small cap stocks in particular have gone down a reasonable amount. We put out an announcement a few days ago just pointing out that the NTA of Mirrabooka had fallen by more than 10%. And we did that because we just wanted to make sure the market was being informed about what was happening. So we just want to make sure our shareholders understand what's happening in the market. So we put out that release. I guess that these things, markets go up and down, and there's cycles within markets. And obviously we've been experiencing one through the strength in the pricing and quality stocks. That's sort of unwound now very quickly. It's like all things in markets, things tend to go up slowly, but when they go down very quickly. However, when we stand back and look at the big picture, the longer term performance of the fund is still very pleasing. And we look through our portfolio now and we see we've still got great companies that are probably trading at more sensible type valuations now. So in that regard, I think the portfolio looks like in a very healthy state. So Kieran, do you want to add something to that?
Yeah, no, thanks, Mark. I guess as mentioned earlier, we saw the conditions building for the market being quite vulnerable to something like this. But I guess the question is, when's that going to play out? And the reality of that is no one ever knows. And it's probably played out fairly suddenly. But I guess markets always have their challenges. And over the last sort of few years, as those valuations have been building, we have found challenges in that because some of our preferred companies have reached levels where our enthusiasm to buy more was waning because of those valuations that were built in. So I guess a bit of volatility is actually healthy, we think, for our long-term prospects surrounding this portfolio for maximum value. So while you don't like to see your share price and your NTA fall away, in a medium to long-term view, we think it's healthy and will provide really good opportunities, albeit we're not in a mode of rushing at this point in time. We think, when these conditions change, you need to, I guess, get adapting to the conditions that are now in front of us and take a patient view and really pick through the best opportunities.
Okay, thank you. Thanks, Mark and Kieran, for your time. And shareholders, we will see you again in March for a webinar and also for the results in July. Thank you very much.